Welcome to the Drive-By Entrepreneur Podcast, which exists to bring current and compelling content to entrepreneurs and influencers of small to mid-sized organizations. I'm John Frank, fellow entrepreneur and the owner of Third Road Management. And with this podcast, we will connect with a variety of experienced and dynamic individuals to shed some light on both the art and science of entrepreneurship. Before we begin, I'd like to thank our sponsors. First, my very own Third Road Management, a company that brings fractional CFO services to small and mid-sized organizations by revolutionizing the CFO suite. We'd also like to thank Two Hound Red, a brewery and restaurant located in Glen Ellen, Illinois, that is focused on creating classic, innovative beer and food. And finally, we'd like to thank NWC Media, which provides inbound marketing technology, project workflow management, and efficiency consulting to organizations of varied sizes, who is also the producer of the Drive-By Entrepreneur Podcast. Laura McNaughton, welcome. Glad to have you here on the podcast. Excited to dive in today. Appreciate you being here. I always like to start out just explaining about the podcast. Mission statement is that the Drive-By Entrepreneur Podcast exists to bring current and compelling content to entrepreneurs and influencers of small to mid-sized organizations. I use organizations rather than businesses because some are nonprofit and things of that nature. So we're trying to kind of get everybody in one place. And what I try to do is bring in either, entrepreneurs themselves or just people that sort of like operate in and around small to mid-sized organizations that have unique perspectives and experiences that can, lend themselves to, teaching something to somebody they may not know, right? So that's what we're here to do. Great. I appreciate you being here. You are a managing director at Kroll Investment Banking Division. So why don't you tell, me and the audience tuning in a little bit more about who you are and what you do as a product of that.
Fantastic. All right. Well, as you said, Kroll Investment Banking, I've been with Kroll for over 20 years. I've spent my entire career working with middle market businesses, helping them execute sale transactions. Started with Kroll relatively right out of college. At the analyst level, I've worked my way up to a managing director. When I joined the firm, we had about 250 professionals. We had 3 offices, Chicago, Los Angeles, and New York. Fast forward to today, we've got over 5,000 professionals. We've got offices worldwide, providing financial services to a variety of companies. We've got within our business lines, we serve over 70% of the S&P 500 in various perspectives. But within our investment banking practice, and we've focused specifically on sell-side transactions, so really working with middle market companies that are looking to sell. We also will help them raise capital if they just need capital to support growth or maybe to take out some shareholders. And we built that around working with family and founders. So when we started, entering the investment banking world, it was providing a high level of service to a portion of the market that at the time was not being served. They were too small for bulge bracket firms. And so we came in and really provided that controlled auction process as a financial advisor to family and founder-owned businesses. Over the last 15 plus years, private equity and the investment into the middle market from private equity has exploded. I mean, there's trillions of dollars of capital that have invested earmarked for middle market private companies. So where we sit today, about half of our transaction activity is working with private equity firms as they look to sell their portfolio companies, which is a great reoccurring revenue stream because they're selling portcos, on average about every 7 years. And the other half remains that kind of foundation of the firm, which is working with those family and founders and helping them sell their businesses.
Got it. And just so I make sure to double click on this, you use the term middle market.
Yeah.
I know everybody defines middle market a little bit differently.
Mm-hmm.
How do you define it?
Certainly, yeah. The definitions for middle market vary. So from our standpoint, our sweet spot is really working with companies with about 30 million in enterprise value on the low end, up to about 500 million on the high end. That often correlates with, call it a $5 million EBITDA business on the low end and go up from there.
Okay. That's perfect. I usually have a couple of themes that I like to hit on. You've touched the surface on the first one, which is just investment banking, right? Like, so in my career, I've been around, investment banking in various ways and forms. Um, Now I tend to work more with companies that are probably on the, you know, I'll call it 1 to 5 million of EBITDA, but certainly some that are a little bit bigger than that. But it's an area that I think is a little bit unknown, and when people first hear the term, they may not understand exactly what an investment bank does. So I guess, as you define it, right? You know, what does an investment bank do, and why do people hire them to do it?
Certainly, yeah. And I mean, there's a broad range of things that investment banking firms in total can do. We kind of focus on a niche within that investment banking umbrella. And like I said, that's largely sell side. So about 90% of what we're doing is helping clients sell their companies. And you might wonder, why wouldn't you just do it yourself? But we do this in a very structured fashion. So we provide a high level of advice to clients. So I'll focus more on the family founder-owned business, but when they're thinking about selling their company, they tend to not know a lot of investment bankers, for one. So they'll typically go to an existing trusted advisor. Maybe it's you, maybe it's an accountant or a wealth manager that they'll talk to, or a lawyer. And they'll ask them, like, hey, I'm thinking about doing this. What are the steps that I take? And in a perfect scenario, we're on the receiving end of that phone call. But before we even get engaged, we'll sit down with a client and provide a lot of advice. And it's really sort of a dual due diligence process back and forth, because I personally will only work on probably 4 or 5 transactions a year. So to the extent that it's not a great fit, it's kind of needs to be a good fit both ways. So we'll provide them with what we call a pitch presentation before we're ever engaged. And that's going to walk through what you're asking, kind of, what would you do for me? What are the steps you would take to sell my business? Who are some of the logical buyers that you would suggest I go to? How would you position the company in the market? And ultimately, what's the valuation you think I could get? Because as a business owner, you really get one chance at going through this process. And if I think your company's worth 50 million and you think it's worth 100, it's probably not a great fit. But there is usually some advice I can give to how to really drive that value from 50 to 100. And all of that's really done even before we're engaged. To the extent that that meeting goes well and you decide as a business owner to move forward with us, we typically will spend anywhere from a couple of weeks to maybe even a couple of months helping prepare the business to go to market. It's effectively a momentum play once you're in market. So our goal is to align all of the buyers to get them to come forward with offers at a very structured timeline. Time in these processes is also your enemy.
Yeah.
And the extent that there's external factors, capital market factors that a business owner cannot control. And there's obviously company specific factors. So you need to be hitting on budgets and projections throughout the process. Right. So you want to be able to kind of consolidate, not to mention the fact that this whole process can be draining on a management team. I mean, as an investment banker, as your advisor, my goal is that I can come in and me and my team can help take some of that load off the management team. But at the end of the day, it is a distraction to the business. So being able to condense the time frame once we're engaged, once we launch a process, start calling buyers to close, it's in everybody's best interest to keep it sort of short. So that's just kind of highlighting some of the things we do, but we do have an entire team that would be dedicated to that transaction, all the way from an analyst level up to a managing director level. And to the extent you were hiring us to run a controlled auction, in that case, we're calling buyers, we're negotiating with them through every step of the process.
Outstanding. And I mean, you've already hit on this, but the second point of, if the first is understanding what an investment bank does, understanding the process, and there's a lot that goes into that, you know what I mean, that we can unpack. But can you walk us through what that process looks like? I know you even sort of prepped it there a little bit, but like, if we want to double click on some of those things, that would be, I think, hugely helpful.
Certainly, yeah. I mean, a big picture, I would say it's generally a 6 to 9 month process from sort of that marketing prep phase up until you could expect to close. And market prep in today's market, like I said, we spend a lot of time getting to know the business, getting organized. We write an information memorandum, which is effectively a book that we use as a marketing tool. So once we start calling buyers, every buyer gets the same information. They get this structured book, and we feed into it financial statements from the company. But these are vetted financial statements. So we recommend to a lot of our clients that they'll get a quality of earnings done. And a quality of earnings is different from an audit in that it's not looking at net income from an audit perspective. It's looking at true cash flow of the business.
Yeah.
So as a buyer, an investor, even a lender, like what's really the cash flow being generated? We used to just let buyers come in and do the quality of earnings. The problem is they wouldn't do that until the end. And so if they disagreed with what your earnings were, what your EBITDA levels were, it was an unfortunate situation as a seller because you might have gone exclusive with a buyer and suddenly you've got a huge valuation gap. So we propose do that up front. That in and of itself can take 6 or 8 weeks to get the Q of E done. We'll plug those financial numbers into our information memorandum and then we'll launch. So we will start contacting buyers. We don't call anybody that's not approved by the shareholders, but that'll include both strategic buyers, which is generally corporates, competitors, that would be logical acquirers of this business. And it also includes what I'll broadly call financial buyers, which is a whole host of private equity, could be a dedicated private equity fund. There's a huge proliferation of family offices that are investing directly in companies today. It could be a fundless sponsor. So we'll call buyers and create this sort of momentum play that roughly 4 weeks after we call them, we'll ask them to provide initial indications of interest. The vernacular we use is IOIs. So you'll have your targeted IOI date. In today's market, you're selling a $5 million EBITDA business. I'm probably going to have 20 roughly indications of interest. We'll lay those out. At this stage, it's very high level. It's a range of value and some high level terms and conditions that you would propose for the deal. But just kind of putting on paper, why are you interested? If it's a private equity firm, what experience do you have in the sector? And then we'll talk to the shareholders and decide who they want to spend time with. And typically buyers at this stage are going to want some direct access to the management team. So we'll work with the management team. We'll turn that information memorandum into a management presentation. Depending on levels of sensitivity and confidentiality, oftentimes we'll invite buyers in to sit down, meet with management, take a tour of the facility, and we'll try to structure some sort of social event. So it might be dinner the night before, it might be lunch, the day of. And you could expect a week or two of those as a management team. Now shareholders, if shareholders are management, they're involved. If shareholders are separate and distinct from management, maybe they're involved in the dinner, but not the meeting, where we can be flexible. So, and we also, again, a lot of our clients aren't used to these presentations, right? These aren't CEOs of public companies. So we'll spend a week or two ahead of time just kind of coaching them. I mean, you generally have a sales and marketing person that's excellent. They can give up and deliver their portion of the presentation seamlessly. You might have a CFO or a controller that really struggles. So just kind of coaching them, getting them prepared for what questions they might get asked. And then after these meetings, go back to the shareholders and say, based on the meetings, who do you want to spend some more time with? We will post a whole host of information, virtually every legal, business, financial document of the company on a secure online data site. Online data room will selectively give buyers access to that information, and then we'll give them another 4 weeks to come back to us with a second round bid. So this is that sort of 2-step marketing process. This is your second step. It's a letter of intent. It's going to be more official and formal. Still not binding. I mean, nothing's really binding until you get to a full-fledged purchase agreement, but this is going to be 1 point in value and a lot more about the terms and conditions. We'll also typically ask for a markup to a purchase agreement. So we'll work with the client's legal counsel to come forward with a relatively seller-friendly purchase agreement. But ideally, you're getting multiple buyers to mark that up. Yeah. Because at the end of the day, for a seller, it's critical that you have the right value, but what is their true walkaway money? What are their escrows going to look like? What are kind of some of the holdbacks that a buyer is going to want? You just want to make sure that everybody's similar with regard to those terms, or at least put something on paper that you could work with. You're not going to fully vet the purchase agreement at this stage, but it's also, it's great intel. And from a competitive and negotiation stance, it's just nice to have multiple parties involved. But at some point, these buyers will want exclusivity. And at some point, the business really, the size of businesses we work with cannot, handle multiple diligence streams from multiple buyers. So generally come to a point in time where you got to decide who are we going to go exclusive with, and then how can we shorten that time period of exclusivity. And there's typically a number of things that need to happen during exclusivity. Obviously, finalizing purchase agreements, legal documentation, schedules to the purchase agreement, all of that. But more importantly, there might be some key diligence checklist items that you're not going to let multiple buyers do. For example, you're not going to want multiple buyers calling your customers.
Yeah.
So there might be a period of time, call it 45, 60 days, where they're sort of going through these final checklist diligence items. It could be customer calls, it could be supplier calls, working with the management team for management contracts, all those types of things. But in a perfect world, then you're marching to close.
Got it. Okay. That's great. There's a couple of things that I was just writing down a couple of notes, but one of the things that you talked about was confidentiality, right? And when you said calling customers and calling vendors in particular,
yeah.
But I also know that it's on the minds of a lot of the business owners that I work with, that the idea of their competitors knowing that their business is out there for sale is like, no way,
yeah.
Right? And I think it's one of those things that it's sort of like the boogeyman kind of thing, where they get really, really scared of that, and so they basically are like, well, I don't want to go through this process, right? Because I don't want to hurt my current business, what I have, right? So I know obviously there's non-disclosure agreements and things like that, but like, what are some of the things that you communicate to a business owner to say like, hey, this is a lot of people have gone through this process. Here's how we protect you, all that kind of. We vet the buyers. I mean, what are some of the things that you would typically say to give people peace of mind in that regard?
Yeah, there's always concerns over confidentiality with those family and founders, and not wanting it to get out, not wanting it to get used against them from a competitive perspective. Obviously, we have non-disclosure agreements in place that loosely could protect them. Like I said from the beginning, we don't contact any buyers without their approval, and I think that's one thing that's important. I mean, it's their business, so on paper, I might think it's a great fit with a strategic buyer, but if they know fluently that like their management team would never mesh with that management team or other external factors, maybe it's not a great buyer. So we can talk about those things. I think it's also a lot of times top of mind who to disclose within the organization and within their company.
Yeah.
And we work with them, again, to figure out at some point, just based on the description of the process, right? These buyers want to meet with the key members of the management team.
Right.
So you typically at some point need to bring them into the fold. And I'll be honest, if you're not willing to bring management into the fold, it will detract from value. You just won't have the level of interest. So bringing them into the fold is important. We oftentimes, if this is a management team that's been, critical to the success of the company, and family-owned businesses typically don't share equity, but we do talk to them about is there reason to put together some sort of bonus pool to help you through this process.
Right.
Some of those bonuses could be tied to the ultimate valuation of the business. If it's ultimately sold to a private equity firm, maybe they get a bonus and then they reinvest part of that into the new transaction, which helps for a seamless transaction because it gives the private equity firm buying the company commitment that these managers really do believe these forecast projections, all of those things. So, but I've also been, I've done facility tours on Sunday mornings at 5 a.m. when no one's in the operations. We respect that it is, a client's company at the end of the day.
Yeah.
And our goal is that if something does go sideways and a deal doesn't get done, we'd like to leave the company just as good as we found it, because there's a lot of instances I can tell you where I worked with a business owner, capital markets cratered in the middle of a sale transaction. We all shelved it, but 2 or 3 years later, we ended up, executing a successful transaction.
Yep.
So we are very thoughtful about confidentiality concerns, within these organizations.
Yeah, it's good that you mentioned the early morning stuff too, because I know that would be another one if it's not the management team, but the team in the factory or on the floor or whatever. You know what I mean? They see these people walking around like who's that? Why are they here?
Exactly. There's only
Why
so
was that
many
different group
times
of-
like lenders can walk through, and if we're structuring 10 of these over a 2-week period or something, it becomes more of a distraction too.
Yeah.
I don't necessarily think it's gonna ruin the company, or it's just you want your employees focused on their day job, not worried about the future of a business.
Yeah.
And it's definitely more top of mind with those family founder owned companies. Generally speaking, if you're private equity owned, these employees recognize the business is going to be for sale. They're kind of, once you're private equity owned, there's sort of this perpetual state of being for sale. As long as you are private equity owned. I speak from experience because Kroll is private equity owned. I know
Right.
that we're always, for sale to the next private equity firm or the
Right.
highest bidder.
Right. And I mean, you hit on this like different pieces too, and I want to just double click on a couple of them again. But in terms of things that you would say to an owner of a business, hey, you need to do this, otherwise this isn't going to be worthwhile,
Mm-hmm.
right? You mentioned bringing the management team into the fold, right? Is there anything else that you would say like, hey, don't do this unless you're willing to do this, or that you don't want to do that? Anything else that, like, I'm just curious.
I mean, I would just say, big picture, it's obviously not a process that any shareholder would want to go into lightly. You don't do
Yeah.
this just to like kick the tires and see how much it's worth. Like you need to be pretty committed to selling, and we're pretty good from a valuation perspective. We're the world's largest valuation firm. So I think I can probably give you pretty good guidance about what it's worth. So we don't actually need to go to market to decide what it's
Right.
worth. I would also just say companies in general, the size of businesses we work with, tend to underinvest in certain facets. And it's a good thing because overhead does sort of kill businesses, and you want to be profitable, but they tend to underinvest in that finance and accounting function significantly.
They sure do.
So whether it's getting, a fractional CFO in place, and this is all things that would help, but they might have a bookkeeper, they might have a controller. And not just in the people, they tend to underinvest in the systems around their finance function. And so they can be great business owners and entrepreneurs and successful thinkers, but buyers, there's always this sort of unstated discount for businesses they can't diligence as thoroughly as they want.
Yep.
And a lot of times the gaps in diligence comes from a lack of systems or personnel in that finance function.
Right.
So to the extent that you're a business owner and you're thinking, sometime in the next handful of years, I'd like to sell this company, I would definitely take the time to sort of invest in and around that finance and accounting function, and be that, getting reviewed statements if you just have internal statements, or getting audited statements if you're currently getting reviews. All of that can be great, but also thinking about the systems that you're using. And we definitely don't want to be doing like a system implementation while we're trying to sell a company.
Right.
And you actually don't want to be selling a company like a month after a system implementation. You need a couple of years to get comparable data, over a series of time. So if your exit is 5 years, 10 years down the line, like, make those investments today. I promise you it will, the value you're going to get for the company will far outweigh the immediate cost.
Yeah. And I mean, thank you for hyping through growth management for a minute there. But no, I've literally been in the room with a private equity group and a business owner where the private equity group said, well, the reason I'm willing to do this is because you have him here, meaning me.
Yeah.
And that, I knew what was going on. I knew how to answer their questions, what was really underneath the question that they were asking, kind of thing. So anyway, I think that that's really, really important, which actually is connected to a different question. What makes a business really attractive, right?
Yeah.
Versus, what are some of the things that like come top of mind for you?
For sure. I'd say, I've worked with a lot of really great businesses over the years, and some of kind of the key themes, regardless of industry or sector, I think first and foremost is goes back to business school 101, but does this business have a reason for existence?
Yeah.
Are they providing some sort of proprietary product or service to their customers? Or if they disappeared tomorrow, would their customers care, or do they just pivot and buy that product or service from a competitor? And typically that fleshes itself out in margins and profitability.
Yeah.
So a lot of private equity firm buyers will have kind of a funnel, right? So if I call them with an opportunity, it kind of has to, before they'll even take the book, they have to check a number of boxes, and profitability is a lot of times one of those. And it could just be like a minimum gross margin level or a minimum EBITDA percentage. And I'd say if you get to an EBITDA percentage of like 15% and up, you're just going to get a higher level of interest. Interest leads to competition. Competition leads to value. So profitability is one. Diversity of the customer base. You can be a really great business, but if your customer base is tied to, one or two or a very small number of customers, you're going to have trouble from a lender perspective. It just leads one to believe that you don't control your own destiny. So if something happens to that specific customer or a very small group of customers, it can be detrimental to your business, and it has nothing to do with what you actually did. So that's more of a negative, whereas a diversified customer base, I love to see a company whose top customer is less than 10% of revenue, just as an example. And it's got a lot of customers and repeat customer relationships. I don't want to see new customers every year, but I do want to see a diverse base of customers. And then in addition, like I said, some of the investments in the finance function, but more importantly, growth of the business. So you got to think from an investor or buyer perspective, like, great, you've had consistent earnings for the last 5 years. That's awesome. But that's what the existing shareholders benefited from. What are you going to do for the next 5 years?
Right.
So strong profitability and also a foundation for growth. And it's just like your basic discounted cash flow analysis, right? It's like, if you're a growing business, I can afford to pay more for you. So having a compelling, tangible growth story. And we do work with management teams to sort of crystallize that growth story. A lot of the companies we work with don't do 5-year forecasts and budgets and long-term planning. They just don't. They're family founder-owned businesses. Like, if you ask how they're doing, they can look at the distribution they took last year and tell you that they had a phenomenal year. So we'll work alongside them, but it definitely has to be tangible. So, new product introductions. Is there a buy and build strategy? Is there consolidation within their segment? A private equity player, these guys love to come in and be the first level of institutional capital that can help do some sort of buy and build strategy across the platform, and maybe buy the base business for 6 times EBITDA, go and do a bunch of add-ons for like 4 times EBITDA and sell it for 10. That's their nirvana. So if you can put forward a tangible growth story, that will help drive value. And then strength of the management team, which sometimes can be counterintuitive for that family or founder-owned business. You've got a founder who's thinking, I'm going to sell this so I can retire and be done. If there's no succession planning, if there's no management team left behind, it can be a challenge for private equity players or strategic buyers. And you think about corporates today, they're generally running pretty lean. They don't have a lot of access within the sort of C-suite executives. And if they're making an acquisition, it's because they want to get into a product or a service line that they're not currently in, which means they need a management team to actually run that product or service line going forward. Your flip side is a private equity fund. When you look at a middle market private equity fund, they might be investing $500 million in capital. There might be 10 professionals investing $500 million in capital. They might have 20 existing portfolio companies. So you can imagine, just by doing the math, they're not running the day-to-day operations of the businesses they invest in. They're going to oversee it from a board level. They're going to help bring in strategic advisors, but they're not going to be part of the C-suite. So the strength of the existing management team is truly invaluable to kind of driving value and what I would say makes a great company.
Yeah, I mean, I see this all the time where business owners are, it's how much cash can I pull out of the business, right? And I always, when I talk to them about this, I just say, look, there's this like trade-off, right? Where you can take every dollar out of the business, right? And ultimately that's going to impact the valuation down the road if you want to sell it, right? Or you can invest in a management team for this business, right? Relieve yourself of some of this burden that you carry, because most business owners, right, like work around the clock, right? Just constantly, right? And on the back end of it, the business is going to be worth more. because it doesn't require you to be running it, right?
Yes.
And that dynamic is, I feel like it's hard for people to commit to,
Certainly.
it's good to hear you call that out as well, because I experience it myself quite a bit. Anything that you would say kills deals? Like I would say, you were talking about this a little bit before, but above and beyond the business fundamentals, right? I've always heard this phrase like time kills deals, right? Like you said, it's a longer period of time that they get to uncover whatever they're going to uncover, or they got to hit the numbers that are in their forecast. Or like you said, if they miss a number, all of a sudden they're, going back on the price and emotions get involved and all that kind of stuff. What from your perspective, what are other sort of typical deal killers?
Yeah, I mean, first and foremost is that the financial performance. So we work with our clients. They're setting out budgets and projections. Like you want to hit those budgets and projections, meet or exceed expectations. You certainly do not want to be in a position, because even if you sign up a letter of intent, you still have probably 2 months of financial results to provide to the buyer before you're actually closing. So you better be hitting those forecasts or projections, because you have a poor month and it's just going to cause consternation and possibly a retrade, right? I mean, it's basic math. If your EBITDA, you lose $500,000 in EBITDA and it's a 7 times multiple, you just lost $3.5 million in value. So financial performance, hitting budgets, hitting forecasts, which can be a challenge because it is your management team's being sidelined by virtue of
that's what I was going
process.
Yeah, that's what I was going to say, and that's what I see.
Yeah,
is that time period where they're basically shifting all their time and energy towards the sale process as opposed to running the business. That's when I can see things, sort of going off track. Yeah,
no, it's a real risk, and like I said, a lot of the heavy burden of the diligence falls on that CFO, who typically is also overseeing technology and insurance and benefits and multiple hats, right? So layer on, now you have this new job and assisting a buyer in their due diligence, and it becomes hard to juggle. So that's number one. The second thing is really just either buyer or seller remorse. And in the case of those family and founder-owned businesses, a lot of times it's seller remorse. And I can't pinpoint because in every scenario it's different. But you can just tell that the buyer might come back with something they feel like is unreasonable, and even though it might be a minor deal point, they just take it to heart. And they decide, this is not the right partner for us. We're going to walk away. And those conversations are almost harder to get over than the retrade because you missed the budget, because that's math. But if buyer or seller just has a change of heart for a number of reasons, it can be even more challenging.
I would broadly characterize that as emotions
For sure, especially on the seller side. And from a buyer side, it can be the latest headline in the Wall Street Journal. You never know, which goes back to time. So just like condensing that amount of time, getting the momentum, and closing the deal.
Do you ever talk to a business owner that's going through the sale process and just say, look, this is going to be extremely emotional. You're going to come to me 5 times before this thing is over and say, I want out. And I want you to tell me here and now that you want me to keep pushing you, or whatever it is. You know what I mean?
You have to, there's always a time where you switch gears from banker to therapist. And I'm certainly don't have the right credentials, but there is always that couple of phone calls where, and I will say, I can't think of an instance where after close, they weren't thankful, that you got it done. But it's very emotional. And a lot of things come into play, right? It's not just about the highest value for these business owners. A lot of times it's about their people. It could be about the location. I mean, we work with companies in very small towns. They could be one of the leading employers of the entire town. So there's just a lot. It's a heavy burden for them to carry.
For sure.
And which makes it, can help drive that sort of.
Well, who wants to be the wealthiest person in town where everybody hates
no friends? Exactly.
No, I totally get it. Um, is going through an auction process, and I use that word auction, meaning like sort of the process driven, time driven process where bids are due by this date kind of thing. Is that always the best strategy from, either getting the highest valuation or just process in general?
I think what's critical is that you have either real competition or the threat of competition. So there's certainly instances where I've worked with clients, they've gotten approached by a strategic buyer, and it's a buyer that's put a really favorable price down, and they're willing to kind of walk that walk with a buyer without going to market. But by virtue of bringing Kroll in, you've got the threat of competition.
Right.
I mean, it's kind of silly, but I've even sat across buyers with like a draft of the book over here, just to show them like, hey, this meeting doesn't go well.
Yeah.
We're ready. I'm going to start
Yeah.
calling all of your competitors tomorrow, and bring in competition. So there's cases where you can get it done with one buyer. I can't guarantee that you're going to maybe maximize value. You'll never know unless you call the other buyers. But it goes back to some of those themes we've talked about as a business owner. Maybe it's more important that this buyer is going to be good to your management team, good to your employees, keep it in the existing location. There's a whole host of things that might come into play where they might be willing to just get this deal done, forego that process that can be distractive to their management team and their company, and enough is enough for them. So, I think it's really just the threat of competition to keep up the momentum, because if you're just trying to do something one-off, it can sideline, and time is your enemy. So it kind of all goes back.
No, that's a good point. I like that. And you touched on this before with respect to either the letters of intent or purchase agreement, but some of those key terms that are part of those deals, indemnification clauses, holdbacks, seller financing, all that kind of stuff. Could you unpack a couple of those just to because I know that when I've had conversations with business owners about that, they kind of look at me like, wait, what do you mean?
Yeah.
They think of it like a real estate transaction where you're like, well, this is the price and I give you the money and we walk away, so maybe just hit on a couple of those that are common.
Sure. Yeah. Well, so rep and warranty insurance has changed that market exponentially, I'd say, over the last number of years. So generally deals of our size, buyer or seller is getting rep and warranty insurance and putting into place. So I would, if you go back prior to rep and warranty insurance, I'd say 10% escrow was pretty common. So this means I buy your business, 10% of the proceeds is going to go into an account for, call it 18 to 24 months, just to make sure that everything goes well. And there's no claims against the escrow. If there is a claim, indemnification claim, it's going to go to the escrow first. Fast forward to today, that's been whittled down because of rep and warranty insurance. It can be less than 1%. There's going to probably be a little bigger escrow tied to a working capital. And we could have an entire podcast about working capital.
It's a really fun conversation.
It always ends up in a battle, every transaction I've worked on. And it is hard for someone that hasn't done this process to get their head around it. But call it, you've got a certain amount of receivables and inventory in the business. Me as a buyer, I'm going to require that at close. That's the appropriate amount. And that's going to get shored up probably 30 or 60 days after close. So that usually equates to call it like 2.5% of the purchase price, but it's pretty quick, right? I mean, the accountants will come in, do their work, verify the closing balance sheet, and that money will either go to buyer or seller, hopefully back to the seller. But really the escrow amounts have been kind of minimized by this insurance policy that you can now get. Outside of that, I mean, things like earnouts, we always look at it and say, make sure you're getting at close what you really want out of this deal, because earnouts can become complicated, and the only people that I think really make money is the lawyers that are fighting over the language of the earnout. So we try and push as much of the proceeds to proceeds you get at close. If there is an earnout, keep it to something that's very easy to define. I mean, even at call it gross margin versus EBITDA. But those are tough. And then seller financing, it hasn't been that in vogue as of late, because prior to, the last 12 months, the debt markets were so open that you would just get at third-party debt. I could see a scenario where you see more seller financing proposed going forward, but it wasn't that common, over the last number of years.
Yeah, well, I think it's probably a little bit more common in small deals,
sure.
right, where there's not as robust of a market from a lending perspective.
Definitely.
And then rolled equity would be another one. I don't know.
Rolled
Yeah.
equity is something that's going to be very common if you're considering a structured private equity deal, and it's actually a great vehicle in my mind. So if you've got that seller of the business who's thinking, there's still a lot of growth in this company and it's doing really well and the public markets are terrible, so I'm going to sell it. And then where do I actually put my proceeds? A rollover gives them the ability to get the second bite at the apple. So
Right.
if they sell their business, they can roll, and usually they can roll a meaningful percentage in pre-tax money. So, simple math, if they get $100 million, maybe they take 5 million and roll that over. They actually get the benefit of leverage in that transaction. So they're going to have a meaningful ownership stake going forward. Private equity owner goes to sell it in 5 years. We like to see that rollover on a pari passu basis. So we like to see the sellers to hold the same class of equity as the private equity firm. And in which case, they could get a nice check in 5 years based upon the ultimate sale of their rollover equity. So, and that's something that, if you're talking to business owners, it's also becomes important, or not beneficial, I'll say. Private equity firms love to invest in a company where the management team's sticking around. As we've mentioned, even better is a case where the management team has some equity and they can roll that equity into a new transaction.
Right.
In addition to the rollover equity, they'll often put together an option pool. So if you do have that management team that maybe they don't have equity ownership today, but they've been an integral part of the story, if they hit forecasts and budgets, that team could end up owning 10% of the company by virtue of an option program. And most private equity firms will put together an option program for key members of management, both existing management and then maybe if they need to augment management, bring in new people.
Very good. Yeah, I've seen it to where business owner might be reticent about the idea of rolling equity because they're like, it's sort of like externalizing the locus of control.
Mm-hmm.
You know what I'm saying? Well, I built this. I don't know if I want to let somebody else, control what I do with this money, kind of thing.
Certainly.
Right? So that's like on one side of the coin. The other side of the coin is, like you said, taking a bite of the apple. It's like, hey, why don't, you can take some chips off the table.
Yeah.
You can take most of your chips off the table, right? But let a few, stick around because, like you said, I mean, this could be on a good trajectory, and you've taken enough off the table most of the time to have some level of security for you and your family. Let a few ride, because then the other thing that I've heard as an argument from people is, if you take the money out, right, and you go put that money in the public markets, let's say, right, you have an investment advisor that, diversifies your, investment pool and whatever. Well, you may want a portion of your net worth in private equity, right?
Exactly.
And why not have it in private equity in a business that you know about, and you have an opportunity for some outsized, gains on it,
Certainly. And I mean, we do advise clients as well, similar to an earnout. It's like, make sure the proceeds at close that you're happy with, right? I mean, I'm all for, and I've seen business owners do really well with the second bite at the apple, but it's still a privately held business subject to external market factors, and you can't guarantee that 20+% return that the private equity guy is trying to get. So make sure that you're happy with that check at close. But if you can roll over some, it could work out really well.
Yep, absolutely. All right, so we've hit on understanding investment banking and understanding the sale process. Last thing I wanted to hit on is just understanding the market right now. 2023, obviously there's the banking, situation that's going on. Interest rates are high. The, public markets have been, crazy and impacted, and just it's an interesting time in history. Let's say.
For sure.
As you look at it from a market perspective, when it comes to M&A transactions, what do you see right now?
Yeah, I mean, the M&A markets are cyclical. This will probably be like the third cycle of my career, and volume will be down this year. There's no doubt about it. And just given the lending environment, I feel like business owners in general are a little bit skittish of making decisions because of some of the uncertainty. That all being said, we still see a lot of interest from buyers, and both on the financial front as well as strategic buyers. So if you just look at like the S&P 500, I think they have a couple $1 trillion of cash sitting on their balance sheets. If you look at the private equity universe, there's 1.3 trillion in available capital earmarked to investing in private companies. So when we take companies to market in this environment, we're still getting a fair amount of interest. I would say valuations have come down a little bit, largely driven by the debt and the capital markets. But there's definitely some underlying subsectors that have withstood. So we look at things like healthcare, you look at infrastructure spend. There's certain areas that are typically recession resistant. We're getting a high level of interest in some of those companies when we do go to market. But we have also seen a shift from financial buyers to strategic buyers. So year to date, across our industrials practice, 75% of the companies we've sold that have closed have gone to strategic buyers. In comparison, in all of 2022, it was more of a 50-50 split, strategic buyer versus financial buyer. And I think that's just related to the capital markets and some of the angst amongst lenders, higher interest rates, all of those things. So 2023, I think it'll be down slightly, but I think the future of M&A looks very strong. And if you've got business owners that are considering a sale transaction, as we've talked about today, there's so many things that need to be done before you actually go to market. I would strongly encourage them just to start getting organized from their books and records, financial statements, systems, all of those things. Consider investing in that finance function. Put yourself in a stronger position so when the markets are a little bit stronger, you're ready to go.
Yep. Yeah, that was part of my question was what can they do now, right? To be prepared. What about a case where, let's just say somebody was thinking about selling a year or two ago and they missed the boat, right? Or they think they missed the boat, right? Because it's a little bit softer now than it was then, right? One school of thought would be, well, just ride it out until, better days, but a couple of years from now or something like that, right? But that's also not to say that they couldn't still go through, a process and still get, a decent valuation on their business. I mean, what would your advice be to somebody that feels like they might have missed out or missed their window of opportunity or something?
Yeah, I mean, there's still a strong level of interest. There's still a lot of private equity money out there. Maybe in that scenario, it's one where that second bite at the apple becomes more important. So they could sell now and then roll some equity and have another future cash flow opportunity 5 years down the line. Or they could spend the time to kind of reorganize and clean up the business. A lot of it depends on how the company individually is performing, right? So that's the one thing that capital markets cannot control. Or if the company's performing and earnings are strong and there's still a good growth story around it, I would say go. I mean, if that's really your goal and objective, I'd have to give you sound advice on what we think we could get for the business. But there's no shortage of activity out there. Both from the private equity front as well as strategic buyers that have kind of been stuck on the sidelines for a couple of years.
Okay, good. Well, this has been enormously helpful. Tons of good insights. I'm going to have to listen or watch a couple of times just to make sure I soaked in as much as I possibly can. But no, thank you so much for being here. This is awesome. We do have final 3 questions.
All right, final 3 questions.
I'm curious about your answers to these. Okay, first one is favorite podcast besides this one.
Yeah, of course.
Of course. And earlier today, when we were getting ready, you mentioned that you were a little bit of a podcaster. So
I do listen to podcasts. I have to admit, I mean, the majority of them are like finance, daily finance and accounting podcasts, Wall Street Journal, CNBC kind of stuff. So nothing exciting. I'm really like more of a traditional old school. I read books.
Okay.
I actually go to the library. So I'll tell you my current favorite book. I'm reading a book about Mary, Queen of Scots.
Okay.
If you've never learned anything about her from a historical perspective, she's fascinating. She ruled in the 1500s. She was declared queen when she was 6 days old.
Oh, wow.
And it's really like Game of Thrones,
Mm.
only this stuff actually happened.
Wow.
So I highly encourage anything about Mary, Queen of Scots.
Okay. All right. That feels like a Netflix show in the making.
Right, it should be. I mean, it's there's no dragons, but it's
no,
it's good.
no dragons, but yeah. All right, great. All right, best concert you've ever been to?
All right, best concert. I don't know if you've heard of Darius Ruckers.
I think I've heard
So
of it before.
Hootie and the
I'm just
Blowfish,
kidding
the
around.
90s. All right. So my best friend is a strict Darius Ruckers fan. So she got us VIP tickets to see him in Fox Theater, which is a smaller kind of boutique-y theater in St. Louis where we're from. So we got to meet him, tour the theater, meet the band, front row seats, the whole thing. So I am committed Darius Ruckers fan after that experience.
Very nice. Yeah, there's I've become in my age now, the mid-40s, I've become definitely a little bit of a ticket snob. I don't go to that many shows. Then the ones I go to, I want to actually like feel like I'm part of the experience.
Yeah, we were front row, and he's a great artist, songwriter, all the things. But just to have that smaller boutique theater, like I think I might want to never see a concert in Soldier Field again. It's just such more of a personal experience.
I know exactly what you mean. All right, last one is a place that you've been that everyone should visit one time.
All right.
Or at least one time.
I'm going Amalfi Coast in Italy.
Okay. I feel like we've gotten a couple of Amalfi Coast boats on
popular
there.
place. Yeah, it's
popular place. Any like particular town or?
It's special. Well, Positano is amazing.
Okay.
We had friends get married out there a number of years ago, so lots of good memories.
And just what about it draws you? Is just kind of like
the beauty. I mean, it's just gorgeous.
Yep.
Yeah, I can't. It was also my first trip to Europe. I should caveat it by just saying it was my first European experience. So maybe it's jaded. I mean, you can take me anywhere over there and I'd probably be happy, but Amalfi Coast, everyone should.
No, but the beauty of it, I'm sure settles in. And then you have sort of like the European, like just chill, relax.
Exactly.
We'll take care of this.
Perfect.
Well, great. Well, thank you again for being here. This has been amazing. I think people are going to get a lot out of it. So really appreciate your time, friendship, and wishing you a great rest of 2023.
Thank you, John.
All right. Thank you.